Hello, everybody. At this time, we are talking about an exchange rate. An exchange rate is the value of a nation's currency when it is traded for another currency. The relative strength or weakness of a nation's currency has a strong impact on its trade with other nations, on its tourism industry, and on the prices its consumers pay for imports. Exchange rates are always viewed in relation to the exchange rate of another currency. And then how exchange rates work. How do exchange rates work? Why are different currencies worth different amounts? And why do they constantly fluctuate? There's no simple answer, as the forces that set and move exchange rates happen on a global stage. International trading, monetary policy decisions, investor expectations, the political climate, and the overall economic conditions all have their say. Whether a government uses a fixed or system plays a major role. So do supply and demand. On the foreign exchange market, inflation, and interest rates. And then, why do exchange rates matter to your business? This impact your costs. If you import goods, a stronger local currency can mean lower costs, while a weaker one can make imports more expensive. And the second, change the value of your investments. If you have investments in foreign currencies, exchange rate changes can affect their value in your local currency. And then third, reflect your revenue. If you sell overseas, a weak local currency can boost your revenue as your products become cheaper for foreign buyers. Thus, it is crucial to manage your exposure to these fluctuations to maintain your financial health and remain competitive in the global marketplace. And then we move to the factors that determine exchange rates. Understanding how and why currency fluctuates can be a big help when sending money internationally or converting currency before you travel. Of course, not everyone wants or needs an in-depth analysis. If that's you, check out Western Union's currency converter calculator. Use it to quickly calculate current exchange rates for popular currencies. The first about inflation. It is the first factors. High inflation reduces a currency's purchasing power, making exports more expensive, weakening demand, and leading to a drop in a currency's value. And then the second factor, economic growth. Gross domestic product, or GDP, measures the health of an economy, and GDP growth signal stability and investment opportunities. This is attractive to foreign investors and can increase demand for the nation's currency, positively affecting its valuation. And then third, interest rates. Central banks use interest rates to stimulate or cool economic activity, which affects exchange rates. Higher national interest rates attract foreign capital and make a currency more attractive to hold. Conversely, lower rates tend to have the appropriate effect. And then we move to the types of foreign exchange rates. The first type, fixed exchange rate. A fixed exchange rate is a system where a currency's value is held relatively constant against another currency or a group of currencies. This stability is achieved by central banks actively managing the exchange rate. For businesses, fixed rates offer predictability. This makes it easier to plan international transactions and forecast costs. And then we move to the second, floating exchange rates. Floating or flexible exchange rates are the opposite. Their value is determined by supply and demand in the FX market, which means it constantly shifts based on Forex. And then the third, managed float exchange rate. A managed float, sometimes called a dirty float, is a hybrid approach that combines elements of both fixed and floating regimes. The floating exchange rate is more commonly used by countries nowadays. And then, how do exchange rates affect the supply and demand of goods? Changes in exchange rates affect businesses by increasing or decreasing the cost of supplies and finished products that are purchased from another country. It changes, for better or worse, the demand abroad for their exports and the domestic demand for imports. Significant changes in a currency rate can encourage or discourage foreign tourism and investment in a country. And then, why exchange rates are important? Exchange rates are important to the first about international trade. Exchange rates affect the cost of importing goods and the prices businesses get for exporting products. Those exchange rates directly impact profit margins and a country's competitiveness in international trade. While a strong currency can make import cheaper, it isn't always beneficial for exports. For example, a weak currency makes it cheaper for businesses and people abroad to buy country's goods. This can grow your country's economy and tax revenue. And second, foreign investment. Investors look at things like exchange rates, political stability, and economic growth to inform their decision making. A strong currency and attract more foreign investment. I think it is enough. Thanks for watching.